Major funding for these broadcasts is made possible by grants from Chase Commercial Term Lending and New York Community Bank, M&T Bank, Perfect Building Maintenance, Capital One Bank, the Wyckoff Group, Greenberg Traurig. Additional funding is provided by grants from AKA Hotels, Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Colliers International NYC, CPEX Real Estate Services, Cushman & Wakefield, Customers Bank, DDG, Dime Savings Bank of Williamsburgh, Douglaston Development Levine Builders, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Foley & Lardner, Friedman LLP, Gemini Real Estate Advisors, HAP Investment Developers, Herrick Feinstein, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Chairman USRealty.com, John Katsimides, Red Apple Group, Kilroy Architectural Windows, New York's Window Company, Madison Realty Capital, Massey-Knackle Realty Services, Matone Group, Mercantile Commerce Bank, Meridian Capital Group, Newmark Grubb Knight Frank, New Banks, MHP Real Estate Services, People's United Bank, SJP Properties, Sterling National Bank, Sterling & Sterling, Stonehenge Partners, TD Bank, Terra CRG, The Continuum Company, CUNY TV Foundation, the Moynihan Group, Urban American, and These Friends.
There was this bank robber, Willie Sutton, and he said, you know why I go to banks? Because that's where the money is. So today I've assembled these 4 bankers to provide me their insight on how they see the real estate market, how they see the business market, and how they see the economy with interest rates continuing to be low and where it's going to be in 2015. My guests, they include Frank Korzelwinski, who is the Executive Vice President in charge of real estate for Flushing Bank, Joe Orefice, who is the Senior Vice President, Head of Real Estate Lending for Investors Bank, Ralph Bumbaca, who is the Senior Vice President in charge of New York City for the C&I business for TD Bank. And last but not least, my fellow classmate, going back many years, only a couple years, Mike Devine, who is the Vice Chairman and President of the Dime Savings Bank of Williamsburgh. So since you and I are the kids over here, how do you see the market? You know, we were talking prior to the show, each year there's a new competitor out there. You know, we have the Bank of the Ozarks is a new player over here. Webster Bank is coming in here. First Niagara has come over here. You know, we see enough TDs over here, you know, I can get my coins changed over there. How do you see the world today in the banking environment since you've seen it a number of years?
Well, from our point of view, New York being the urban colossus that it is very, very competitive, as it always has been. But it also provides spectacular opportunity. With the growth of the population over the last few years, the high quality of life, and the outlook for more population growth over the next 15 years, we think opportunity is unabated.
That relates rather well to the discussion we were having in the green room with regard to why lending to the multifamily business continues to be a very strong market.
Yeah, I mean, it's one of our favorites at Investors. We do quite a bit of it, like most of you guys here. We see it as, again, as a constraint of supply, even with new production coming online with new population growth. So we kind of view that as a continued squeeze economically upward in terms of rental rates and capacity.
You know, over your career, you've seen banks come in and out, but we've seen rates today stay pretty constant over the last 18 months. I mean, I mean, I'm not an economist. I don't have the crystal ball. The crystal apples are over there. But how do you see I mean, how do you hedge yourself? Because 5 years down the road, you know, you don't know where the market's going to be.
Well, to be honest with you, when I first got into business, I wrote my first loan at 10%. So it's been downhill since then in terms of interest rates. But I don't know if there's any real clear forecast for where rates will be 12 or 18 months out. But I think there's a strong consensus that there's not going to be any sudden move or rapid move in any long-term phase for some time to come. From the credit side, I think we all have a very disciplined model in trying to figure out what's the right level of leverage for an operator, whether it's an apartment building or a commercial property, because we know that we've seen rates, when I first got out of college, they were 21%. So we know that there is a top side. I don't think you can perfectly match where you're going to be. But one of the tricks I learned way back when was try to always leave something on the table for somebody else to take you out. So I think we're in good shape. I think the commodities market for now has cooled off nicely. It's going to be a big win for everybody with fuel expenses over the next heating season.
I think that's really an interesting subject about the heating fuel and the airline fuel. I mean, the airlines who have increased their prices on everything are not reducing their prices, and now they're going to be buying futures the same way that Southwest did this a number of years ago. So how does, you're the Canadian. Everyone else here is basically a regional bank, a regional community bank. You were a community bank. How does the Canadians, which has always been more conservative in their lending in residential and in all sides, what's their mantra today with regard to the local market, with regard to C&I business, which is commerce and industry, industrial loans, and the real estate market?
I think going forward, it's still going to have a focus on our community banking perspective. We really partner with the entrepreneur from a C&I perspective. We're active in various asset classes in the real estate market, so we'll continue to support through community regional lending and various asset classes in real estate to drive the brand awareness that we've built over these past 13 years here in the United States.
I'm sorry I don't have that big pop-up, over here that you normally have on the stages, but
we enjoy that. The brand has really been very well receptive here in the United States.
How important is it to brand to get the business that you want to get today? How important is that branding with regard to getting customers and doing business?
We think it's very important. Matter of fact, we went through a rebranding prior to our second step offering earlier this year. Where we changed the name from Investors Savings Bank to Investors Bank. We added a fancy logo and some colors. I think we mirrored some of your TD
Wait
stuff
a second.
originally.
Wait, I don't want to say I don't see the button on you, my friend.
Don't tell me. Don't tell. I forgot.
It's a violation.
Kevin,
One violation.
it's a violation over here. Yeah.
But I think it's very important, especially as you want to position into new businesses and you want to have really that professional cachet to be able to do high-end real estate, not just the small balance stuff, but again, into more sophisticated clientele, both on the CRE side and the C&I side. So to me, it's a big part of the business. And one of the things we've seen recently, obviously, Flushing, you could speak about that, but we've seen it from Astoria. We've seen it from others.
I mean, with regard to Astoria, they have spent a lot of money recently in their print media ads, and I think also on the radio ads, with regard to saying, we're Astoria Bank. We are no longer Astoria Savings. They're trying to emphasize that. While you are continuing to say, we're Dime Shares, Dime Bank Shares, but you're still Dime Savings Bank.
Well, we are still Dime Savings Bank. We're a very traditional savings bank. Nothing to be ashamed of since we make good money. We have high profits.
And you've been in business 150 years?
We're celebrating our 150th anniversary. I was not there at the very start. And branding is usually a prelude to growth. And the idea of branding in most cases is to try to reduce costs and increase revenues and watch it go to the bottom line. We are more of a niche player. And at $4.3 billion by New York standards, we're a small bank.
Now, you're similar in size, right?
Just about $4.8 billion. We've taken branding in a different fashion. Astoria made a conversion by name, going from a savings and loan to Astoria Bank. We converted to a New York State chartered commercial bank. Our brand is to move away from the this national thrift model to a more prominent commercial banking model. Since the largest share of our assets are in commercial real estate and multifamily projects, we felt we were always held back a little bit by being viewed as a small thrift trying to compete in a big market. So the conversion to a commercial bank has enabled us to enter into much more sophisticated relationships. We now have a more robust deposit system to better service the client's needs on location. We've added different types of technology so they could bank in the office, do wires from the office. It's just been really instrumental in thinning out our branch network, which I think we'll probably end up growing because we're small, but it's certainly helped us enrich.
Prior to the show, I had mentioned the discussion that certain people who are buying retail sites have said to me when they're looking at branches. I mean, needless to say, you go to 42nd Street where you had the Bowery Savings Bank, which is Cipriani today. You had, the Williamsburgh Savings Bank in downtown Brooklyn, the Williamsburgh in Williamsburgh over here. Banking is changing, the environment is changing, and we're going to probably have smaller branches that we just discussed that you're implementing over here. My question really relates when you're a bank and you're trying to get new business, and I hate to say, and the borrowers are out there, they believe you're the new kid in town, so we have the opportunity to take advantage of you. Over the last 5 years, SunTrust, Fifth and Third, Tri-State Bank out of Pittsburgh, Bank United, all of these new players, People's United over there. So when you're over there, how do you make the decision to keep your restraints, not to go crazy?
Well, we've seen this before in the marketplace. I guess there's been pepped up demand after the recession. A lot of banks.
Unfortunately, Mike and I will probably have seen it. No. I'm not aging ourselves in the S&L boom. I think that I think that's the best example. And you may have been around at that time, and you were there because you were at the S&L. The S&Ls in the '90s were over there. I remember Morsemere. I remember numerous New Jersey institutions and S&Ls who are no longer today.
Right. Same thing that's occurring now. We see stretching on structure, some covenant light deals, pricing, because they need to try to acquire some market share. And it's a strategy that will play out over time. Those that continue to be consistent in the market and stay close to their customers will continue to succeed.
Well, I agree. If you do something well in life, you will do well in life. And avoiding institution killing bets, as great as the temptation is from time to time, is sometimes a hard thing to do, but in the long run it obviously pays off. And
we were talking before, prior to the show, about risk-reward in banking. And one of the subjects is one of the most riskiest business, which a number of new players get into, is the risk of new construction. Because nobody knows how the market, even though, as Mike said earlier, more people moving here, everything, but we don't know what can happen. Unfortunately, my show started in November of 2001, right after 9/11. And people said, is anybody going to move to Lower Manhattan? They had to create incentives. And, we've seen different cycles over there. How do you, and we don't have that crystal ball, how do we look at it and how do we make the determination to try to be conservative and not take the risk? Because no one sitting here is really a major player in construction. It's not something that you went into. And then if you look at it this way, Bank of America, who was in the business, then left the construction business and now wants to be in the business again.
Well, construction lending is a very important part of a banking activity. We have a very, very small portfolio. At one point, we probably had about $200 million in construction loans, but there were a lot of things going on, as you mentioned, post 9/11. I mean, I remember the first construction loan I did in Manhattan started a couple weeks before that, and then we couldn't get sheetrock in Manhattan, and we're up to the sheetrock stage. So there's a lot of different variables that you can't factor in. But I think if you let construction lending be a part of your business and not lead your business, I think you could manage it effectively. Most institutions that failed in ADC loans were highly concentrated. Probably, I've heard stories as much as 85% or 75% of their assets were in acquisition, development, and construction, and it was no balance. There was no room for them to recover if something went bad.
And also at that time, which I think the banks are more structured, a number of the financial institutions had these development companies, subsidiaries, that they invested in the real estate transactions. You know, some of these builders, I mean, I think Beechwood was one of them, who went into business with a number of the precursors of North Fork Bank. And they did well, because in certain parts of the 90s they did well, but then the S&L boom changed that. How do we look at the business transactions, the banking opportunities within the other boroughs today?
Well, we're very active. Probably Brooklyn is our number 2 location, just by virtue of the growth and the opportunity that we've seen out there. So, you know, we like Queens, we love Brooklyn, we even like Staten Island, although there's not a lot of product out there for us. So, you know, in terms of where the economy is and the next step, I mean, I think it's something to watch in terms of, you know, how much upside does it have? Now it approaches Manhattan
I think I
levels.
I didn't hear the term the Bronx.
Do the Bronx also, to be, but it's not an area of rapidly increasing rents. I mean, there's a lot of stabilized product there, which is a great business, but it's not, you know, the super churning of real estate values that you see in the other boroughs where you have real opportunity to adjust rents.
Frank? And the suburbs.
I think,
yeah, sure.
I think what Joe is saying is sort of the Bronx is somewhat of a forgotten borough because it is very vibrant. Has a very good manufacturing and industrial section in the lower end. And a lot of those properties are being developed as you come over to 3rd Avenue Bridge. A particular section.
The hub over there on 3rd Avenue is doing really well.
Yes.
And I think if you look at the boroughs in their entirety, I just think there's so many things going on in so many different subcultures that it's almost limitless what can be done. Queens has the Chinese and the Korean population explosion. We have just an overall growth in the Asian population from the Middle East as well. The churches that are being built all around the outer boroughs and the temples. Just go back to what Mike says about the number of people coming, the infrastructures that are being built to create the attraction for these people to come. It leads to new stores. It leads to building out new stores. You know, certain people in transportation have to speak certain languages. It's just unbelievable what's happening out there.
And don't leave out the tech triangle in Brooklyn,
right,
and the effect of startups and technology, in particular in Brooklyn.
I think that's where the growth is. It's in the job creation that has occurred, that has kind of broken out from the Manhattan community into the various boroughs, and even into the Bronx now too. The manufacturing, a lot of real estate has become available for other development in the Brooklyn and Queens market that has benefited the Bronx from a manufacturing and from a development perspective.
Today, you know, over the last couple of years, there have been probably 15,000 new hotel rooms being built. I mean, you've seen more limited service hotels, and now you see some very ultra expensive 5-star hotels, you know, like the Park Hyatt, you know, and the new Four Seasons over there. How, as a bank, do you look at, you know, these other asset classes, such as, you know, the hospitality, the retail, the industrial within the region and so on? Mike?
Well, we're not investors in those because we are primarily a multifamily lender. But they're related to our market because they bring commerce and people.
Right. I mean, I think a great example is, you know, the Wythe Hotel, which opened up not too far from your headquarters in Williamsburgh. You know, no one projected, I believe it was an M&T loan that they did, and there was some tax credits even because of the historical tax credit. No one believed how well that property would be doing.
That's right.
And you know, what's happening in Williamsburgh, you're going to have your first Whole Foods. And what we were talking earlier about in the Gowanus, now that we have, you know, a Whole Foods, the 60. 60,000 square foot Whole Foods, which I believe ranks in the top 5 in the nation in sales.
Right.
Well, still no substitute for density,
Absolutely.
right? I mean,
Well, and
Whole
don't
Foods in
forget-
the suburbs doesn't have the volume.
Yeah, Brooklyn has more permanent residents than Manhattan, and would on its own probably be the 4th largest city in the country.
How do we look at, you know, on a number of shows, a couple weeks ago, I did a show on Long Island City, and that's a vibrant area because of the transportation, which relates to something that we were all talking about before. If you're near TOD, transportation-oriented development, it's really very valuable. I mean,
We're actually going vertical, which is unusual for Long Island. There's a right next to the Mineola Courthouse, there's a new 10-story residential development, which is very unusual for Long Island. Usually if it's over 2 stories, they don't want to deal with it. It's right next to the train station. It's a 30-second walk out the back door to the train station. And I think just a little bit west, there's another development going up. It's maybe up about 4 floors. So I think they're not just in New York City alone. I think that throughout the metropolitan area,
I think
there's a whole...
definitely. I mean, what Avalon Bay did in Rockville Center is one
Right.
of the examples, and
A huge success.
Right, a huge success, and Ralph lives out there. And then in certain parts of New Jersey, in Morristown, it's been a...
Yeah, I think we've seen, you know, on the Jersey side of the river, we've done quite a few projects, but every single one of them is contingent upon the transportation to the city as the primary driver of rental. You know, you've seen the success of the project out by the new train station out there. What's it? I'm trying to think. Outside of Jersey City, we have a whole bunch of new construction. Several of the guys that work for me live there, so it's about 2 stops to downtown, and it's the same story in terms of the economic success.
And the price is right.
And the
too.
price is right. That's right.
I mean, the differential in rent in Jersey City to Manhattan is nearly 50%. In certain markets. A brand new building in Jersey City is renting for $42 a foot, 40 to 42, and a brand new building in Manhattan is at $85 to $90 a square foot in that market. As bankers, how do you look at this rapidly increasing world on condo prices? It may not be a market that you're really into, but, you know, as banking executives, how do you look at that? Because, you know, I still remember when $1,000 a square foot to me was expensive, and I did a show a week ago, and, you know, they're talking $2,500, $3,000. I mean, the affordability is leaving.
I said we see those projects. We really do. I mean, New York is an international city, so there's a lot of external high net worth demand that comes into the city. But, you know, I think it's a category that we're not particularly comfortable with because, let's face it, $20 million units or $10 million units, there's a lot of margin for deduction.
But even, you know, my office is on 50th and 3rd. There are 2 new developments that are being built there. One is on 51st Street and 2nd, where they're getting $2,100 a foot, and then there's another site on 50th and 2nd where they're trying to get $2,400 a foot. To me, 1,000 square foot apartment is $2.3 million. You know, you live in Connecticut, you know you can get a very nice property. You
can get a
live
good
in
property
Long
for
Island
that, yeah.
for, you know, in New Jersey also. I mean, the question is, you know, what's affordable and where can people afford to live? I mean, Jersey City sounds like the possibility, and they are building condominiums now in Jersey
Yes.
City, you know, and so on.
You know, I think it pushes you to the other spots of the area. We're seeing some migration there as maybe stabilized units are moved on the rental market to other boroughs. I think the for sale market is a very interesting market here in New York City because there is such a giant diversity. And the high end is so high. That,
And they're cash buyers.
And they're cash buyers.
And not a lot of financing going on, not a lot of permanent financing going on.
And I normally don't throw this toughie type of question, but this one is thinking right now in my mind. You know, there's been discussions on the condominium to charge a pied-à-terre tax. There's been discussions last year, the rent increases on the rent was like 1%, you know, over there. What happens if we have, you know, these rent controls? You know, if rents don't go up, taxes go up, water goes up, insurance goes up, fuel may go down this year, but it's only, you know, a temporary blip. How do you, as a banker, you know, to protect your risk reward, look at this?
Well, we're in the part of the market that caters really to blue-collar workers. 3/4 of Dime's portfolio is collateralized by rent-stabilized and controlled apartments. So we think there might even be a halo effect created by the high end of the market by making that limited supply of stabilized apartments that much more valuable. And that's the way we view it, but we're in kind of a special spot.
Yeah, I would say that I agree with you that that is an opportunity for those units. But if there was some sort of statutory limit on even increases in the stabilized apartments, I mean, that's be a major concern for some of those.
I think it would take a few years of repeated no increases, for instance.
Pendulum swings, you know, both ways right
Yeah.
now. It's sort of against landlords for rental increases. I think that those powers that be in New York City and the Department of Finance are smart enough to know that there is a fine line for how long
up to a point.
that they can continue to have such restrictive pricing mechanisms, because, as you said, fuel in a month could go up 25%. And taxes, it's no secret that taxes have gone up, you know, 4 or 5% a year for the last 5 years.
Where do you see interest rates maybe a year from now?
I would say probably in the same range. I don't see anything chasing us away from where we are.
I agree. I think we're going to see very little in the early part of 15, but then we probably will see things heating up. We're also going into an election cycle. It's going to create an interesting dynamic around how the government responds to that.
You know, I was an economics major in college, so I don't know if that counts. That was my.
We were accounting majors.
But you know, I view it actually longer than that. I don't see that there's a sufficient national economic boost here that really drive rates well beyond that. As a matter of fact, if you had asked the question 2 years ago, oh, in 2 years, who knows what they'll be? Well, they're going to be the same or less.
They have.
I kind of view it to be fairly stable for some period of time.
I would generally agree, except remind everyone that our first loans in post-Civil War America were about 11%.
Okay.
So there you have it.
So I'm happy that I assembled the bankers to give their thoughts. I think we've had a good discussion. I'd like to thank Frank, Joe, Ralph, and Mike, and I'll see you next week.